In the fast-paced world of money, where people can get rich or lose everything in an instant,
Dropped. Wow. Are you kidding me? Oh!
there's something called the stock market. It's like a big game where people buy and sell parts of companies, hoping to make money. But underneath all the excitement, there's a scary possibility. The economy might take a nosedive, causing what's called a recession. Imagine watching the news and seeing experts talk about how things might go wrong with the economy. They mention worries and risks. It's like a dark cloud hanging over everyone's head. People remember past times when the economy crashed, and they worry it might happen again. In the complicated world of money, there are times when everyone feels really good, and other times when reality hits hard. As we go through ups and downs of the global economy in 2024, there are signs that things might not be going so well. In this video, we'll look at why this might be happening and studying signs and trends that suggest big financial trouble could be on the way. One big hint that the market might be in for a rough patch is how the economy is doing. Even though things have been pretty good lately, there are signs that they might start to slow down. Things like people feeling less confident about spending money, paychecks not going up much, and prices starting to rise all suggest that the economy might not keep growing like it has been. Also, there's something called the inverted yield curve, which has been a pretty good sign in the past that a recession might be coming. Economists and investors are paying attention to these signals because they could mean trouble ahead for the economy and the market. Alright, to make this super quick so I don't waste your guys' time, if you guys learned something new or enjoyed the video today, please drop a like and subscribe. I really need views, likes, and comments, everything. I'm super desperate. Alright, I'm going to stop wasting your guys' time. Let's get back into the video. So real quickly, I'm going to brush over normal yield curves versus inverted yield curves. A normal yield curve, usually when you invest your money for a longer time, you expect to get more back. So, longer term investments have higher returns compared to shorter ones. This makes sense because you're taking on more risk by locking your money away for a longer period. On the other end of things, inverted yield curves, sometimes things get flipped around. When the yield curve is inverted, it means that shorter term investments start giving higher returns than longer term ones. This can happen when people are worried about the future and want to keep their options open. It's like saying, I'll take my money back sooner because I'm not sure what's going to happen later. When this happens, it can be a sign that people are feeling pessimistic about the economy. Over time, when interest rates on short-term loans are higher than those on long-term loans, which is called an inverted yield curve, it happens often before the economy goes into a downturn. In the United States, this pattern has occurred before most recessions, usually about 12 to 18 months before things get tough. It's not a perfect crystal ball though. Sometimes the inverted yield curve happens and there isn't a recession afterwards. But because it has been right so many times, economists, investors, and policymakers pay a lot of attention to it as a signal of potential economic trouble ahead. When investors think the economy might get weaker later on, they often prefer to put their money into longer-term bonds because they see them as safer. This makes the prices of these longer-term bonds go up and the returns or yields go down. Sometimes, this demand for longer-term bonds makes the returns even lower than shorter-term ones, which flips the usual pattern of returns and creates an inverted yield curve. So, if in 2024 we see the yield curve flip, it could mean that investors are worried that the economy might slow down or even go into a recession soon. This worry could come from things like people spending less, businesses investing less, or the government making it harder to borrow money. When the yield curve inverts, short-term interest rates are higher than long-term rates. It makes policymakers like central banks take notice. They might rethink their strategies for controlling money and decide to lower interest rates or take other steps to help the economy grow and avoid a recession. If in 2024 the yield curve stays inverted or flattens even more, policymakers could feel pressure to act early. They'd want to support the economy and reduce the chances of a downturn happening. Asset prices in financial markets have been soaring in recent years. This surge is largely due to easy money policies and a lot of speculation. But here's the concern. These high prices might not be sustainable over the long haul. That means there's a chance they could drop significantly. Investors use a couple of important numbers to judge if stocks are a good buy. The price to earnings ratio, PE, and the cyclically adjusted price to earnings ratio, CAPE, right now, these numbers suggest stocks might be too expensive compared to how much money they're making. This can make them vulnerable to a big drop in value. The CAPE ratio, also known as the Shiller PE ratio, is a different way of looking at how expensive stocks are. It adjusts earnings for inflations and the ups and downs in the economy instead of just looking at 1 year of earnings. It looks at the average earnings over the past 10 years after adjusting for inflation. This ratio gives a longer-term view of whether stocks are priced fairly. It smooths out the effects of short-term changes in earnings. In history, when the CAPE ratio is high, it has often meant that stocks are very expensive compared to their long-term earnings average. This has sometimes led to periods where the market was overvalued. On the other hand, when the CAPE ratio is low, it has sometimes come before the stock market went down and even before recessions happened. In 2024, both the PE ratio and the CAPE ratio are showing signs that there could be a recession and a drop in the market, mainly because of things like a slower economic growth, tensions between countries, which we've seen with Israel, Palestine, Ukraine, and Russia, or changes in how money is controlled, could make these risks worse and make a recession more likely. Wars create uncertainty about what might happen next. Investors don't like uncertainty because it makes it harder to predict what will be safe to invest in. They might worry about how the conflict could affect businesses, trade, and the economy. Even if a war is happening far away, it can affect the whole world. Countries might impose sanctions or trade restrictions. This can hurt businesses that rely on international trade and make it harder for them to make money. Wars in certain regions like the Middle East, which include Israel and Palestine, can affect the price of oil. Oil is crucial for many industries, so if prices go up a lot, it can make everything more expensive. This can slow down economic growth. Wars can shake up investor confidence as well. When people are worried, they might sell stocks and investments to protect their money. This can cause prices to drop in the stock market. So, conflicts like these can have a big impact on the stock market because they create uncertainty, affect global trade, influence oil prices, and make investors nervous about the future. Central banks are really important because they decide how much money is available and how expensive it is to borrow. When they start to reduce how much help they give to the economy and make borrowing more expensive, it could make it harder for investors, which might cause prices of things like stocks to go down. Also, the government's decision about taxes or fiscal policies and spending are super important too. They can really change how well the economy does and make the stock market go up and down. In 2024, these decisions could make a recession more likely or help stop it from happening. Changes in tax rates can have big effects on how much people spend, how much businesses invest, and how well the economy grows. When taxes are lowered to encourage spending and business growth, it can give the economy a quick lift. More money in people's pockets means they can spend more, and lower taxes for businesses can make them want to expand and invest. On the other hand, if taxes go up, people might have less money to spend, and businesses might not make as much profit. This could slow down spending and investment, which are really important for the economy to keep growing. In 2024, if tax policies change, whether taxes go up or down, it could affect how much people spend and businesses invest. This could either make a recession more likely if taxes go up and spending goes down, or help prevent one temporarily if taxes are cut and spending gets a boost. Government spending is really important for helping the economy grow, especially when things are tough and the economy isn't doing well. When the government spends more money on roads, healthcare, schools, and helping people, it creates jobs and makes more demand for things people need. This helps the economy grow. But if the government decides to spend less or cut back on things like schools and programs, it can slow down how much the economy grows. If these cuts are big enough, they could even cause a recession where the economy shrinks. In 2024, changes in how much the government spends, whether they spend more or less, could affect how fast the economy grows and how likely it is to have a recession. More spending could help protect the economy from problems, while less spending could make problems worse and make a recession more likely. When governments spend more money than they bring in through taxes, it leads to budget deficits. This means they have to borrow money, which adds to their debt. Having a lot of government debt can cause problems. It can make it harder for private businesses to borrow money because there's less available. It can also make borrowing money more expensive for everyone. Plus, it limits how much the government can do to help if the economy gets worse. In 2024, if the government keeps running bigger budget deficits and the debt keeps growing, it could worry people. This might make markets more up and down and make it harder to know what's going to happen in the economy. It could even make a recession more likely because of all the uncertainty. To wrap things up, it's hard to say exactly when or how big a market drop might be, but there are clear signs that 2024 could bring trouble. Economic indicators show things might slow down, and prices for investments are higher than they should be. Plus, there's a lot of uncertainty around the world. Investors and people who make decisions about money should pay attention to these warnings and get ready. The problems in the financial markets could get worse, so it's smart to be prepared. With all that being said, I hope you guys enjoyed the video. If you learned something new today, go ahead and subscribe to the channel and slap a like down below. So let me know down below, do you think we're headed for a recession? Are you prepared? Do you have money set aside and saved? I know things might be tricky right now with how expensive things are and, wages not necessarily going up. It's best to be prepared to your best abilities. Now, finally, with all that being said, have a good night or day, whichever it is for you. Peace out, guys.